What's the right portfolio structure for you? And the risk monitor is going to help you manage that risk. So if you've come through this cycle and you're upset with yourself because you didn't raise enough cash, okay, guess what? Market's going to give you another shot. It always does. We'll be in that situation again where we have big alpha, huge gains. Market was skyrocketing 2 weeks ago for us. Commodity stocks were skyrocketing. Okay, next time, remember how it feels. Sell into it a little bit more if you want, because the risk monitor was red. 2 weeks ago, the risk monitor went red. The 11th of April. Market still went higher a little bit. Commodities exploded that week. But the risk monitor red tells us something's wrong. Why does it work? It's not a neural network. It's not guessing what the market's going to do next. All it's doing is identifying flows of capital from institutions. Now, there's many different ways to do that. William O'Neill, whom I respect, likes to look at volume flows. This may interest you to know that volume has nothing to do with the risk monitor. Volume flows has nothing to do with the risk monitor. I respect O'Neill. How to Make Money in Stocks, a brilliant book. I follow the O'Neill strategy. I'm curious when their risk monitor goes red, and it happened this weekend. So they went to red this weekend. They're 2 weeks late, but that's okay. Their strategy always holds on a little bit longer. Their strategy is about volume and distribution days. The ARMR risk monitor doesn't care about volume. It's about confluence. The footprint of the institution, to me, is that everything moves in unison when billion-dollar fund managers are either buying or dumping. And if we can identify when that is happening, that footprint, in this case, a paw print of a bear market, then we can protect capital. Or a hoof print of a bull, and we can get aggressive and start buying. Okay? So 2 weeks ago, Risk Monitor said something's wrong with the market. There's no confluence. Some parts of the market are cratering. Other parts, like commodities, are going up. That's not a safe market. So you got to be aware of that. Now, how do I use that information? Doesn't stop me from putting money in commodities, and commodities had a huge week. But it does put at the top of my mind, something's wrong with the market. So last week, when the market starts to reverse, we're exiting aggressively. We started exiting the uranium stocks Tuesday and Wednesday, right? And then Thursday morning, we were starting to sell things 10 o'clock in the morning, which I almost never do. Why was I that quick? It's because I understand the ARMR report, because I built it. Over time, you guys are going to get used to it, right? And I know that the risk monitor is red. And so when I start to see behavior that's the paw print of a bear market, I have to act as fast as possible. And that paw print on Thursday was an unbelievable 100% down day. Everything was going down aggressively with no rally all day. You've got to read and react to the market. That's what I mean when I say read and react. And I say it all the time, but what does it really mean? It means don't have an ego. Use the ARMR report to help you as a guide, get your mind right, and then execute when you see what's happening. I try to help you with that. ARMR subscribers who are on the live desk, I'm walking you through it, talking you through. I'm saying, we're doing this now. This has to happen now. Something looks terrible with the market. I don't get it. This is a footprint of something seriously wrong with the market. We got to raise cash. And by the end of the day, we had 80% cash in a balanced portfolio. Okay. We have 4 portfolios set up for you. I run my own money this way. ARMR index only. It was 100% cash 2 weeks ago because it follows the risk monitor religiously. Risk monitor is red. It goes to 100% cash. ARMR dividend portfolio, the exact opposite strategy, right? It doesn't care about the risk monitor. It's collecting dividends. Okay, so that portfolio had more capital to work all the way through last week. Okay, Friday it started to get hit, and so we raised some cash there. It's probably going to get hit again today, and I'm going to talk to you about what I might do in the portfolio there in a minute. Then we have our growth portfolio. which is geared off of risk monitor goes green. We start buying our favorite individual stocks off the ARMR whiteboard. We were carrying cash into the day. Maybe on Thursday, maybe we had 15 to 20% cash coming into the day because we had been stopped out of our uranium stocks. I'll show you why in a minute. And then we just raised massive amounts of cash. And then, of course, our swing portfolio for ETFs, which always carries 30% cash because we day trade there. We were able to raise cash fast. So when you see us doing that, what I hope, what my goal with the ARMR Report is to help as a guide, say to you, something's wrong, here's how I'm reacting to it. But my risk tolerance is different than yours. My goals are different. So you got to figure out for yourself, how do I want to structure a portfolio? And how do I want to execute? Feel free to direct message me, give me a call if you want to coach through that thought process. I'm happy to do it. Okay. So I had a thought in my head. I can't remember what it was right now. I wanted to share something with you. Well, maybe it'll come to me. Let's move on with a quick thought on how to use that risk monitor. When we're red, it means max cash. You got to figure out what that means for you. When we're yellow, it means we start to put some capital to work, but we probably do it in less aggressive names, indexes, see if we start making money. And when it goes green, we start getting aggressive and putting a lot of money to work. That's how the ARMR Report works. Okay? So right now we're red. That's our max cash. A couple of thoughts from Spot Gamma for today's trading and this week's trading. I published it for you in the Slack room, and it'll be on the website too. Under the captain's log, you can see it. I've been sharing with you for months now that there's something seriously wrong with the bond market. Okay, this is a complete head and shoulders breakdown in the S&P. But what's really disturbing is what's going on in the bond market. Just absolute aggressive selling. That's treasuries. That's corporate investment grade. And this is high yield. Just total implosion. Now, this reminds me of what I wanted to talk about. Bonds lead stocks. When you see bonds implode, stocks generally follow. They don't have to follow in lockstep. They don't have to follow the week that you think they're going to follow, but they always follow. If the selling continues over here, here's why they follow in a nutshell. Make it simple to understand. Ready for this? If you have, and this speaks to our dividend portfolio and how I may change it a bit this week. If you have the 2-year Treasury note, government paper, which is supposedly the safest paper on earth, and that note is yielding equal to or greater than the yield on utilities, which are equities in corporations, so theoretically there's more risk there, then you've got a problem. And probably what happens, unless there's some massive recovery in bonds, is that utility stocks are going to get hit. Okay? Risk monitor red, breakdown of a major head and shoulders top, is eventually going to get to every stock in the portfolio. If this gets ugly enough, everything's going to go down. Okay? So, for instance, I have utility stocks in my portfolio from a couple of years ago. And I'm looking at them today and I'm saying, I probably have to book my profits in these things. I own them cheap down in here. And I've been just collecting this phenomenal yield, all the way up. Now the yield is at a level where the 2-year note is equal to or greater than some of the utility stocks I'm holding in my portfolio. Where can utility stocks go? They're just going up right now because people are hiding in them. And then eventually there's that switch where investors say, wait a minute, I may as well just hide in 2-year treasuries and collect 3% or whatever that number is. And that's a real bear market. If you're new to investing, a lot of the things you've gone through, they're not real bear markets. You went through a pandemic, it was a crash, then the Fed started buying assets everywhere, market recovered. A real bear market happens when interest rates go through the roof, bond markets get wrecked, inflation's out of control, and everything goes down. And it lasts for a while. Real bear markets happen when interest rates go high enough that the investing public says, wait a minute, why am I taking risk on an individual stock when I can just collect yield in a U.S. Treasury? And they shift tons of capital. Now, I don't know what that level is. Every cycle, it's different. You know, I don't remember what it was in the 70s. I wasn't there, but I've studied it. I don't know what the number is. What was it, 10% or something? It ended up going to what, 19% on government paper? 19% yield on government paper? Who would ever? Don't quote me on that 19. It could be a little less, a little bit more. How about just 10%? Could you imagine putting money in government paper and collecting 10%? Who needs the risk on an equity portfolio? Just give me 10% yield on government paper. I'll tell you one thing. Who the heck needs a dividend stock if I can get 10% on government paper? Do you see what I'm saying? So long, protracted bear markets happen when interest rates are skyrocketing. There's an inflation problem, so the Fed's hands are tied. And bond prices get so out of whack that people start shifting major amounts of capital over there. So I'm not saying that's happening today. We don't know. We got to read and react to what's going on. But we do know that we've collected huge capital gains in a number of dividend stocks over the last couple of years. If we book those profits, it's like literally taking future dividend payments and bringing it into right now, right? Because the stocks are up so much. It's like collecting the dividends. So it's something I'm thinking about in my dividend portfolio. Keeps coming in and out of my head what I want to tell you guys. But let's move on. We do have a large position in VIX. You know, I don't usually hold the position in VIX overnight. Okay, we started holding VIX overnight on Thursday, held it over the weekend. There's the chart pattern of why. Okay, I think VIX at the very least is at the top of this range before the week is over. And I shared with you this chart from Spot Gamma, and it just speaks volumes. Okay, look at the bond market volatility index and look at the VIX. The gap there is so ridiculously wide. One of two things has to happen. Volatility on equities is about to skyrocket, or bond market volatility is going to come down a lot. Look at how they usually correlate fairly well. And the last time bonds skyrocketed, equities volatility skyrocketed with it. That was Volmageddon. Remember that? 2020. Now we're having a massive move up in bond volatility. And the volatility on equities is down here. That, in a nutshell, explains why I'm willing to carry a position in VIX overnight right now. I'm going to try to trade around the core. I'm not going to sell out that position. It's going to open higher today. My guess is it sells off some point this morning. There are going to be vicious rallies intraday, and I'm going to be doubling that position on the weakness. Probably flipping it out by the end of the day, booking a profit on the core, on the tradable part, and holding the core. Because I think the potential of a massive move in VIX is in the offing. And so I'm holding a position in VIX. Now I want to wrap up. See if we've covered everything. I think I have, but I want to wrap up with a discussion here on, let's call it an ARMR education discussion, right? ARMR education, here we go. Why did we dump our uranium stocks as fast as we did last week? Particularly when we did a whole education video for everybody about why we aggressively bought them the week before. Let's go look at the chart patterns. I'm going to make this very simple for you. The idea at the ARMR Report is to do the fundamental research, to understand the potential of the investment idea, and then to read and react to what price is telling us. To not let our ego get in the way, to not argue with the market, right? We don't want to become Kathy Wood and start discussing how the market doesn't get it. Okay, market's wrong. Okay, the market's never wrong. You got to protect capital first, capture upside second. This is why we dumped our uranium stocks aggressively last week. Okay, step by step, here we go. Let's just look at you for a second. Now, we went over these charts the week prior. Whoops. And I explained why we were buying them aggressively. All right, so let's just skip the reasons from a fundamental standpoint. We all know uranium should go up a lot. We bought it right in here at the bottom of this pennant, and the bigger pennant was up here, right? And we said the explosion higher at the end of the week was taking us out of the pennant. Now, here's a news flash. Technical analysis is not a crystal ball. It doesn't guarantee success. All it's doing is telling us where the battle between buyers and sellers is taking place. And when the buyers overrun the sellers, there's a higher probability that the asset's going to skyrocket. But that's a probability. So even if it's right, 7 out of 10 times, let's say a breakout of a pennant leads to further upside, 7 out of 10 times. It means there's 3 times that it fails. And when it fails, it implodes. And the reason for that is that people are trapped. We're not the only ones on our desk that saw the buying opportunity. We bought it early. We let other people mark up our portfolio, so our principal's protected. But we bought it early because we saw the potential of the breakout of that pennant. Everybody else jumped on board. The minute the pennant fails, everybody's trapped. It's a classic bull trap. So at the ARMR Report, it's very simple. We try to buy it as tight to the base as possible, as tight to our stop, which is usually the low of the day we're buying or the day prior. When it pops up like it did by the end of the week, we raise our stop to break even. I don't care how much I love an idea. I don't care what the supply story is and what's going on in the Ukraine. It doesn't make a difference. My stop goes to break even because I've been doing this long enough to know that if I force my will on the market, I will be carried off the trading floor. So when this stock comes back to break even, it's gone. I don't care the reasons. I'm happy to buy it back a couple days later if it holds up. Gives me another entry point, I'll buy it back. I don't care. I protect capital first, then I capture upside. That's the ARMR core value. Okay? So breakout, immediate failure, back to break even, gone. How about UEC? We made money on UEC. Bought it here, skyrocketed. This bar right here. So what? This is Friday, Thursday, Wednesday, Tuesday, Monday, right? We were reducing positions on Monday and Tuesday, and certainly early in the morning on Thursday as it was taking out these lows. We booked a profit in UEC. Now it's below where we bought it. We booked a profit in CCJ. Now it's below where we bought it. Right? NXC, perfect pennant breakout. We owned it right here. Broke out, reversed, comes back down to the breakout. We're out. Break even trade. So to wrap up this thought, never force your will on the market. Do your research, understand the fundamental potential, use the correct entry point. We use algorithms to help us buy it, right? So we're not the guys buying on the breakout. We're buying before the breakout. Let other people mark up our portfolio. That's one way to protect our capital. And then never force your will on the market. If it reverses, goes back to where you bought it, never let a gain turn into a loss. That should be like one of the top 10 rules of anybody managing his own capital. Don't let a gain turn into a loss. Now, how fast you book a profit and whether or not you're selling as it's going up, I'll leave that to you. I have my own reasons and my own strategies of what I do. But at the very least, when you buy something that skyrockets X percent, X being, if it's a small cap stock, maybe it's bigger percent, big cap stock, maybe it's just 5 or 10%, doesn't matter. Whatever the move is, you raise your stop to break even and you protect your principal. That's why we were dumping uranium stocks as fast as we were. It has nothing to do with the fundamentals.